Good evening, class, and welcome to our performance management class for today. Today, the topic on the board is cash management. We have been looking at management of non-current assets the last time, which was capital budgeting. Now we are looking at cash management. Okay, so cash management, we will see the nature of cash management. We will see cash budgets. Now, this is different from the budget we did when we did variance analysis. This is strictly cash budgets and cash flow forecast. Then we'll look at two models of cash management. One of them is called the Baumol model, and the other one is called the Miller-Orr model. Then we will look at other aspects of cash management. So, cash management is a part of working capital management. When we say working capital, we mean those current assets and the current liabilities. So if you say net working capital, we mean current assets minus current liabilities. And what makes up current assets? We have inventory, we have receivables, and of course, cash. So cash management is a part of working capital management. And so let's go straight now to our business for today, the nature of cash management. Now, cash is important in a business. When you come into the business world, they say cash is king. So it is no longer customer is king, but the customer with cash is the king. So if you have cash, it is very important for the liquidity of your business. You may be having a lots of profits. Profits might be so high, but you don't have cash. All your profits are tied down to receivables, and you're also owing. So it's also you have payables, you have receivables, and nothing is in your hand in the form of cash. And so there are some things you cannot do. Your business is not seen as liquid. And so when you do your liquidity ratio, you find out that the business is having the risk of being liquidated. You see the word liquidated because it is not liquid. If a company is unable to pay what it owes at the time required, the creditor will take legal action to recover the unpaid amount. And it could mean selling off some of the businesses. If the company is also slow in paying invoices, so creditors will be reluctant to provide additional credit. So you see why you need cash. And so if all your cash is tied up in receivables, you cannot get further credit, and they may want to take action to recover what you are owing. So it is important that cash flows are managed well so that there is sufficient liquidity. Now, what are some of the reasons for holding cash? One, to settle transactions. You need to pay expenses, you need to settle debts. If your debtors and come for their collection, you need to settle them as at when due. So one of the reasons for holding cash is to settle transactions as at when due. The second reason is for precautionary reasons. So against unexpected requirements of cash. It's just like people usually precautionary when they see fuel tending to become scarce. People want to buy fuel and store because they will, or maybe it's festive period, they think that the price may go high or they may be scarce. Because of that precaution, and they don't want to stop their business, or so they want to buy fuel. The same thing too. Now you have unexpected requirements for cash. You have unexpected requirements for cash. A business deals just come, and you need to make decision to take that business deal. So you are thinking that there will be a need in the future that's unexpected. Sometimes you say unforeseen occurrence. You want to, have money on ground so that in case that unforeseen opportunity comes, you take advantage of it. That's precaution. Then there is the speculative reasons. Um, Now it's somehow linked to the precaution, but speculative is you are trying to make investments, take advantage of investment opportunities. So you are speculating that the dollar might increase. Let's say dollar might strengthen more against the naira, and you may want to hold your cash. Maybe your cash is in dollars. You may want to hold it so that as it increased, you may want to, sell and make more naira. So that is some of the reasons. So you also want to hold a cash because you want to take opportunities that comes your way so that you can get an advantage over your rival. Now, cash, holding cash. Somebody say holding cash. Does it cost you to hold cash? Now, if you hold your cash in your hand, or if you put it in a box and put it inside your house, it doesn't earn any returns. It doesn't earn any returns at all. If you take your cash and you put it in a bank, it doesn't, especially a current account, it doesn't earn any return at all. Instead, there is a cost that applies when you keep your cash in the bank. And so holding cash, of course, it provides the company with liquidity, which is the ability to pay or settle transaction, but it reduces your profitability because income lost from holding the cash is there rather than investing it in a business development. So holding your cash will cost you opportunity. We've learned opportunity cost. That profit that you would have made is the cost for holding the cash. So you have lost that opportunity and it's not, doing you any good. All right, so it means that it is not good to hold too much cash because even though holding cash will make you have the ability to pay, do other things, it is not good to hold too much cash or too little cash. The objective of good cash management is to hold sufficient cash to meet liabilities as they fall due, whilst making sure that too much cash is not held. Now, money held as cash is not being invested and is therefore affecting the profitability and the wealth creating of the organization. Now, if a business wants to maintain sufficient liquidity but does not want to hold too much cash, what can the business do? It might consider investing any cash that is surplus to short-term requirements. Now, short-term cash and surplus cash can be invested in short-term financial instruments or even savings accounts, even some fixed deposits that are term deposits, such that you can earn some money, you can earn interest. All right? Aspect of cash management. You might be required to consider any of the following three aspects of cash management. One, forecasting cash flow requirements and operational cash flow. This is done by cash budgeting or cash flow forecasting. And it says in your examination, it is more likely you'll be required to prepare a cash flow forecasting rather than a detailed cash budget. But you'll be looking at both of them in case anyone is being asked. Now, deciding how to invest surplus cash in short-term investments. Then you will decide how much cash to keep and how much to invest in short-term investments. All right, so let's start looking at these cash budgets and cash flow forecast. What is a cash budget? A cash budget is a detailed plan of cash receipts and cash payments during a planning period. So it means that when you are having a cash budget, there must be a period of time you are looking at. Then you'll be thinking, how much cash will I receive in that period? And how much cash will I be spending during that period? So the aim is to ensure that you know what is coming in and what is going out. So you plan to, if there's going to be insufficient cash when you want to spend, you know you need to source for fund. And if there will be too much cash received that you may not be spending much, you know when to invest. The planning period is subdivided into shorter periods, and cash receipts and payments are forecast or planned for each of the subdivisions of time. For an budget, annual master budget, the cash budget might be prepared on a monthly basis or a quarterly basis. And some businesses prepare new cash budgets even weekly. What are the main uses of cash budget? To forecast how much cash receipts and payments are expected over the planning period, to learn whether there will be shortage of cash at any time during the period. And so when there is going to be shortage of cash, what should you do? You will need to bring in cash. Either you borrow or so. Or if there's going to be a surplus. And if there's going to be surplus, we invest it. If there's a cash shortage, to consider measures in advance with dealing with the problem. So if there's going to be a cash shortage, what measures can you do to ensure that there is no cash shortage? Then to monitor the actual cash flow during the planning period by comparing actual cash flow with the budget, and that's variance. So when you are monitoring cash flow, it means that you have planned that for the month of October, you are going to have this inflow, maybe 1 million, and you are going to spend 800. And so you are monitoring your cash flow and you have found out that you are 20% away from your inflow. You need to analyze what's happening. You need to do more. Or if you're looking at your spending, you have reached 90% of your spending. What happened? You are monitoring them and you need to know what to do so that you do not overspend when you are also not making enough. So, preparing a cash budget. A cash budget can be prepared by producing a table for the cash receipts and cash payments containing each item of cash receipts and each item of cash payment. Then the cash receipt and the cash payment should be listed in rows of the tables, and each column of the table represents a time period such as 1 month. So this is a typical example of a cash budget. This is just a typical example. It means that from cash sales, you have received in January 5,000, February 6,000, and March 5,000. Then the cash from credit sales, 72, 64, and 64,000. Then from other cash receipts, it could be sale of fixed assets. It could be um, sales of shares. Anything that is bringing cash, anything that is bringing cash. So that is not your normal sales, it's a other cash receipt. It could even be sale of your fixed assets at scrap value. Then you have your total cash. So here, if you're looking at cash budget, you're not looking at just operational items. You're looking at everything cash. You're looking at both capital expenditure or capital inflow and operational inflow. And you're not also looking at the time period in which it relates to. Unlike profit, if you are supposed to um, pay your salary or you're supposed to receive something for a particular period of time. Let's say your sales, the credit sales, you have not received the money. You will still record it as sales. You are paying salaries and you are owing for some months. You will still record them as accruals and you will still put them there. But in the case of cash, as long as cash has not been received, you don't recognize it. So even if it is next year that you pay the cash, that time you are paying the cash is when you are recognizing it. But in the case of profit statement, the time you are making the sale, you are earning it, even if cash is not paid, that is when you are recognizing it. We will get to see that. Then look at cash purchases, payment for credit purchases, rental payments, wages and salaries, dividend payments, other payments, and you have your total payments. So they have put the total in brackets. So now your total cash received minus your total cash payment will now be your cash flow, net cash flow. Remember what we did the last time when we were doing capital budgeting, your inflow, your outflow. This is your net cash flow. Then you will need to start with cash at the beginning. At the beginning of that period, how much did you have? How much did you have? You need to add that beginning amount with whatever net cash flow you have. That will give you your ending balance. And this ending balance is the balance as at this month, which will be the beginning balance of the next month. So you need to now look at the cash flow here and regularize it. This now become your ending balance. So here in this case here, the net cash flow in February and March were negative. That of January is positive, giving you a positive net cash balance at the end of January, which becomes a positive balance in the beginning of February. When we brought it with the negative, it gives us a positive cash value at the end of February, which is still the beginning of March. But because the net flow in March is bigger than the beginning balance, it ends up as a negative. This is like an overdraft. So it means in this month of March, there will be a shortage of cash. Right. Cash flow forecasts. Cash flow forecasts, like cash budgets, are used to predict future cash requirements or future cash surpluses. However, unlike cash budgets, they are prepared throughout the financial year and are not a part of a formal budget. They are often prepared in much less details than cash budgets. Now, what are the main objectives of cash flow forecasting? To make sure that the entity is still expected to have sufficient cash to meet its payment commitment as a fall due, to identify periods when there will be a shortfall in cash resources so that financing can be arranged, and to identify whether there will be surplus of cash so that the surplus can be invested. Then assessing whether operating activities are generating the cash that is expected of them. The main focus of cash flow is likely to be operating cash flow. Operating cash flow. Although some investing and financing cash flow might be significant. Now, you see here, statement of cash flow. Statement of cash flow is the kind of idea we are looking at. Statement of cash flow, we have operating cash flow, investing and financing. But the main focus is operating. What cash is generated from operations? Now for investing, investing here means buying and selling of um, current asset, non-current assets. So when you are investing in a capital project, you are spending cash. When you are recovering sales from them, or maybe you are disposing them of, you are receiving. Then invest and financing has to do with um, buying of shares. When you are buying shares, long-term liabilities, you are financing long-term liabilities and you are buying shares. Money is going out. When you are getting dividends or interest, money is coming in. If you are the one paying interest because of loan that you have collected, if you subscribe for your shares and people have bought into that, finance financing cash flow results. If you are in need of debt capital and you are being financed, financing cash flow, then you are the one paying interest, paying dividends, money is going out. Techniques for preparing a cash flow forecast. There are no rules about how to prepare a cash flow forecast. A forecast need not to be the same amount of detail as a cash budget. However, there are two basic approaches. One, producing a cash flow forecast similar to a statement of cash flow using the indirect method. The indirect method of cash flow, you need to bring your profit before tax, you add back depreciation, you add back all those things that do not require the movement of cash. You deal with what do they call that? Working capital items and all that. These indirect cash flow statements. Then forecasting cash flow by estimating revenue and costs to arrive at estimates of earning before interest, tax, and depreciation. They call it EBITDA, 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 earnings before interest, tax, depreciation, and amortization. All right, let's look at the cash flow statement approach. One way of preparing a cash flow forecast for a period is to produce a statement similar to the statement of cash flow. Now, this is how the general structure will be like. Okay, so this is what I was saying before. The expected trading and loss, trading profit in the period. Then you adjustment for non-cash items. So those non-cash items that you that is doesn't require cash. For example, depreciation. Depreciation would have been deducted in your profits to get your profit, like what we did the last time when we are trying to look for tax. We brought our profit, we added back depreciation. So that's the depreciation here. You must have deducted depreciation, so you're adding it back. And so you now adjust for working capital. Now, when we say adjust for working capital, if at the beginning of the period and to the end of the period, there is an increase in inventory. Let's say in the beginning of September, your inventory was worth 5,000. Then at the end of September, your inventory is worth 20,000. Now there is an increase in inventory. What's the difference? From 5,000 you went to 15,000. There is an increase in 15,000. How did that happen? For your inventory to increase, money must have been spent. So increase in inventory requires an outflow of cash. Then if there's an increase in trade receivables, let's say your trade receivable was 30,000, and at the beginning, at the end, it now became 48,000. That means you have granted more receivables. When you grant more receivables, it means you have given your debtors more money that should have been in your business. So increase in trade receivables means an outflow. And of course, if there is a decrease in inventory, if there's decrease in inventory, it means money is coming in, because as they are selling off, decrease, the inventory is decreasing, they are selling off, money is coming. Trade receivables, as they are reducing, it means they are paying you back. Look at trade payables. If you increase your trade payables, it means you have increased the amount you are owing your creditors. It means your creditors are giving you more money for allowing you to increase your debt. So more money is coming to you. Now, but if there's a decrease in payable, it means you are paying back what you owe and money is decreasing. Then you see here, after getting the working capital adjustment, which happens to be this 23 here, you use it to reduce this 56,000, your operational cash flow becomes 33,000. So this is the cash flow you get from operations. Then there is interest payment. You took a loan, you are paying interest. You less the interest. Then if there is a tax on profit that you are paying, you will need to less the tax. So when you have done that, this is your cash flow from operating activities. That is like statement of cash flow. Then you will come and use investing activities. If you sell your non-current assets, money is coming in when you sell them. When you purchase a new non-current asset, money is going out. So the net off between them is cash flow from investing activities. Then you come to financing activities. When you repay a loan that you took, money is going out. When you pay dividends, money is going out. When you take a loan, money is coming in. When you subscribe for shares, money is coming in. Then you have your cash flow from non-finance from financing activities. Now what happened now is cash flow from operation, that's 16, minus this 21,000 from our investment, minus this 27,000. The net change in cash position is 32,000. Then you bring your cash at the beginning, this will be your cash at the end. So we have seen two formats, the one of cash budget, and now we've seen cash flow forecast. Trading profits, profit before interest and tax. Now the expected trading profit might be estimated by projecting the current trading profit, which is trading profit before interest and tax. So you can project what it is. For example, if trading profits have been increasing by 5% per year, and if it were just 300,000 in the year that just ended, you can decide to say, since I have observed that my profit increases by 5%, I will simply, this profit I just had last year, if I increase it by 5%, that would be 1.05, that's increased by 5%, times 300,000. That will give you 315,000 as your profit for next year. That's what we are saying here. Then depreciation and amortization. Depreciation is not a cash flow. It is just a provision for wear and tear. So because we have provided it in the income statement by way of um, prudency, but no cash actually go, because even though you are spending, you wrote your statement of your your financial statement, you have depreciation and you even have accumulated depreciation. How much money did the depreciation go up? It's just an accounting entry to provide for the fact that you are going to replace that asset. No cash has left the office, so that depreciation that you deducted before when you got your profit, it need to be added back to the profit in order to calculate actual cash. Detailed information might be available about non-current assets to enable an accurate estimation of future depreciation charges and amortization. Amortization and depreciation are the same thing, but depreciation is used for tangible items and amortization for intangible items like goodwill, what again, patent rights, and all that. So that's it. Changes in inventory, trade receivables, and trade payable. The figure for profit must also be adjusted for changes in working capital in order to estimate cash flow. The most appropriate assumption about working capital changes might be one of the following. One, that there might be no change in working capital. If there is no change in working capital, that means there is no adjustment. Or that inventory, trade payable, and trade receivable will increase by the same percentage as the increase in sales. Let's say, for example, if your sales is increasing by 5%, you can say that if your sales is increasing by 5%, that means it's possible that your inventory too will follow the same fashion to increase by 5%. Your receivables might also increase by 5%, and your payables might increase by 5%. These are assumptions. So you see here, um, these are, we are trying to create a model, we are trying to create a budget. Interest payments and tax payments. Assumptions might need to be made about interest and tax payments in the cash flow. It might be assumed that interest will be the same as the current year's income statement. It might also be assumed that the tax payment will be a percentage of the figure of the trading profits. So in the exam, you are going to be given the appropriate assumptions to be used. Then the investing cash flow. Cash flow might be included, investing cash flow might be included if it is expected that additional non-current assets will be bought, or that some assets will be sold, or it's assumed that some essential replacement of aging and worn out non-current assets will be necessary. Then we'll talk about financing cash flow to be necessary to include that if the company intends to pay dividends, or the company intends to pay um, to repay a loan, or even to take a loan. Now we'll also have the revenue and cost estimation approach. So here we see the cash flow forecast using this method. We estimate the sales revenue, then we estimate the cost of sales to be a percentage of the revenue. So revenue is seen to be 100%. Every other estimation are percentage of the revenue. So cost of sales, this is about how many percent? Let's see how many percent this was. I know it's about 50 or 60%. Let's say 180 divided by 300. That's about 60%. So 60% of 300 gives you 180. When you minus from that, it becomes a gross income or profit of 20%, then 220,000. Then other expenses, it could be fixed, and they could be fixed costs, it could be other costs. You can estimate a percentage of them. It's like 90. So 90 over 300, let's see how many percentage that was. 90 divided by 300, that gives you about 30%. That's 30%. When you remove 90 from 120, you have your net profit of 30,000. Then you have your depreciation and amortization. By the normal way you calculate your depreciation, and you remove it from that, you have earnings before interest, tax. So you are adding back you're adding this back, because this is your net profit. This is your net profit. You must have removed amortization, depreciation inside these other expenses, and now you are adding them back. But if you didn't remove them here, this will not be net profit. This will be earnings before interest, tax, and depreciation. So it means here that these other expenses, you can forecast that depreciation, amortization will be excluded here, interest will not be there, and tax. So you can say other expenses excluding interest, depreciation, interest, tax, and depreciation. You can call it other expenses excluding ITDA. This is the ITDA, interest, tax, depreciation, and amortization. Then you will get the same thing. All right, so the figure for EBITDA is equivalent to the figure in the cash flow statement for operational cash flow. before the working capital adjustments. So that's it. Now, sales revenue forecast. It says the sales revenue forecast should be based on sales volume in the previous year, and there will be adjustment for sales volume growth. So you have your sales volume, you have your sales in the previous year. You can forecast that you may want to make a 5% increase in volume. So if the price is still the same thing and you increase your volume, you will now forecast. You can even say you want to also increase your price a little, which or you may want to reduce your price, because sometimes when you reduce price, you increase volume. So you might make a forecast for slight reduction in price, let's say 5%, and you have a volume increase of say 10%, and your revenue is forecasted. Then you have your cost of sales. If the ratio of cost of sales to sales, that's the ratio, and the gross profit margin has been fairly stable in the recent years, you might assume that this ratio will apply in the future. Otherwise, you can decide to make um, a forecast on them. In that way, the question will be given to you. Sometimes, like the question we saw the other time of inflation, when we are adjusting. Although inflation may not be the same thing here, they will give you the percentage margin that you'll be using to increase if there's anything. Other expenses can be estimated reasonably. You might assume that there are fixed costs that will not change. Let's say your rent will not change and some other fixed costs. You might also assume that they may change. Other adjustments might be necessary to allow for known change in costs. For example, if there is going to be large increase in raw material, this will affect the gross profit margin. You know, sometimes large, when you increase your raw material, you might buy them cheaper, and also your raw material uh, increase might increase administrative labor costs. Then you have depreciation and amortization. You can estimate them too. Your cost of sales could include depreciation and amortization. Now, sometimes your cost of sales might include depreciation of machines used in a factory, so to get your cost of sales. Then your other expenses could also be depreciation of some fixed asset like vehicle and other furnitures and all that are non-factory oriented. Those ones could be under your other items. So whatever case it is, you need to bring those depreciation or amortization and add them back so that you can estimate your EBITDA. So this is an example. A company wants to make a cash flow forecast for the next year. The following information is available. We have the annual sales and the amount in million. Current year forecast. So they forecast that the current year sales will be 80 million. Then previous year, year one, was 75. In year two, it was, that is, they are going back 1 year back. So 1 year back, it was 75. 2 years back, it was 72. 3 years back, it was 67. 4 years back, it was 64. So it was increasing. The company has achieved a gross profit margin of between 57 and 62 in the past 4 years. So between 57, or possibly when it was 4 years back, and 62, possibly 1 year back. The other costs, which is distribution and admin costs in the current year, are expected to be 36 million. Labor costs make up 25% of other costs. Labor costs make up 25% of other costs. So we have other costs apart from the cost of sales. Okay, sorry. We have apart from, okay, let's say other costs, which is distribution and administration costs, is 36 million. 25% of this is labor costs. These labor costs are expected to rise by 10% for the next 2 years, and then in line with the general rate of inflation. The general rate of annual inflation for the next few years is expected to be 2%. The company currently has 100 million of freehold land, 50% land and 50% building, 40 million at cost of other non-current assets. Buildings are depreciated by 2% per year, and other non-current assets are depreciated over 8 years by straight line method to a zero residual value. The investment in working capital, which is trade receivable plus inventory less trade payable, is currently 120 million. We are asked to prepare a cash estimate. We are asked to prepare estimate of cash flow for operation for the next 2 years. For the next 2 years. Okay, so we are saying that, look at sales revenue. Sales has grown by a factor of 1.25, which is 80 over 60. So let's see, 80 over 60. So we do 80 divided by 60. So over the years, sales has grown by 125%. That's what this place is saying. Please let me make a second instance of this so that we'll be comparing solution with question. Solution will open in a moment. Just a moment. Right. So these are solution. So sales has grown by 1.25 over the past 4 years. This give an average annual growth of 57%, 5.7%. That is fourth root of 125. What it means is that this, let's see it again, fourth root of 1.25 minus 1. Okay, so what it means is that, what's the fourth root? Look at fourth root. How do we get fourth root? This is like square root. This is square root. This is square. Somebody is asking a question. I will write on the board, but I want to explain what is here. So this is like this is like square root. This is square root because there is 2 here. And in this calculator, there is no fourth root. How do you get your fourth root? How do you get a fourth root? So we can employ certain things here. We can use this x raised to power y. Let's show you how to do it. Now, this 1.25 is your root, is your base rather, is your base, which is this x. Then when you press this, it shows you this caret sign. If you want to do fourth root, that means you want to do 1/4. Before you press your 1, open your bracket, put 1 divided by 4. Close your brackets. So this is fourth root. 1/4 is 0.25. You click the bracket. This is 1 point. And now you have to minus 1. This is the 5.7%. If you times this up by 100 now, this is at 5.7. That's what it's saying here. So it means that it might be a good thing to assume that sales has grown by 6% a year in each of the 2 years. So what it means here is between here 64 to 67, sales has grown by 6% or like 5.7. You can just test it out to see. You can say 64 multiplied by 1.06. It gives you 67.84. You see, 67. Because if you have done 64 multiplied by 1.057 to still give you something like that. Now, this is this. You want to check the growth again. You multiply by 1.057. You're getting 71 point. That is almost 72. Multiplied by 1.057. See, you're getting 75. Multiplied by 1.057. You're getting 80. So that is what we mean that the sales has increased 6% in each of the 4 years. So now, let me stop so far. We are saying here that your revenue is your sales revenue. So you have year 1, year 2, year 3, and year 4. And we are saying here 80, 75, 72. This is 80, 75, 72, 67, 64, 72, 67, 64, 67. Let me shift this. Something is blocking me. 67. So this is year 0, current year. Year 1, year 2, year 3, and year 4. So this is 64. Okay. So you are saying here, what is the increase? Because this is where you are coming from, coming to this side. What is the increase? First of all, for the sake of replicating what was done there, we have 80 divided by, this is the current year. The last available year is up to 4 years. We divide it by 64, which is what we did. 80 divided by 64, giving us 1.25. So it means that 1.25. So you say growth over 4 years, cumulative. So this is 1.25. Or we can say 125%. Now, we want to know the growth in each year, growth per year, growth per year is simply the nth root of the growth. So what it means here is how many years is involved? 4. This is the growth in decimal. That gives you then, sorry, -1. I forgot to put that -1. -1. So this this is going to be -1. So I told you how to calculate your nth root. So your nth root, when there is 4 here, this thing here is the same thing as saying, is the same thing as saying 1.25 raised to power 1 over 4 minus 1. So this, when we say square root, is 1 over 2. When we say square, is 2. So 1 over 4, and 4th root here is, sorry, it's not minus. It's not minus. It's not minus. 1 over 4. For it to be minus, it means something must be on top. 1 must be on top. And this is now the denominator. That is when it changes to minus. If it is just a 4th root, this thing here, that is how it is. And we said how you calculate it. Told you how to calculate. You can decide to make this a fraction first. You can decide to say 1.25 raised to power. You can say 1 divided by 4. You get 0.25. Just say 0.25. That way you've saved yourself a lot of headache. So this is going to be, let me copy this 0.25 because I will need it just in case I forget the figure. I will not forget my calculator is okay. Calculator is stiff. 1.25. Calculator is just stiff. 1.25 raised to power 0.25. That gives you this, and minus 1. That gives you 0.05737, which is the same thing as saying 5.737%. So that is how your growth each year has been increasing. So you have succeeded in knowing your growth in each year. So it might be assumed that the growth will be 6% per year. The gross profit margin has varied between 57 and 62. We were told in the past 4 years. So like what we did before, it might also be assumed that the growth rate in sales and sales cost of sales. Okay, sorry. It might therefore be a it might be it might therefore be assumed that in the next 2 years the gross profit will be 60%. Let's see how we can do that. Let's see. Let's say 57 plus 62 divided by 2, we have 59.5. So averagely, you can say it will be 60. So that's an assumption. It might also be assumed that the growth in sales and the cost of sales allows for 2% annum inflation price, because we are told that the general rate of annual inflation for the next few years is expected to be 2%. So the price, the sales price will allow for this 2% inflation. But we are told that other costs are 36 million in the year. So 36 million in the year. And we are told that labor costs make 25% of that cost. So you just say 36 million multiplied by 0.25. That gives you 9 million for labor costs. So labor cost is 9 million, while the other cost will simply be 36 million minus 9 million, which is 27 million. That's your assumption. It might be assumed that if these costs are fixed, it might be assumed that these costs are fixed, except that they rise by 10%. So you see here, they said labor costs make up 25% of other costs. Labor costs are expected to rise by 10% for the next 2 years, and then in line with the general rate of inflation. So it means that this 27 million of the other costs, it might be assumed that these are fixed costs, right? So if they are fixed costs, they may be fixed, except they rise by 10% in the case of labor costs and 2% for other costs. So what it means here is for labor costs, let me write now. So this is what we are saying here. Other costs is 36M. Labor is 25% of 36M, which gives you 9M. Other admin costs, excluding labor, is going to be 36 minus 9, which is 27M. Then we are now told labor costs is expected to rise by 10% for the next 2 years. So we now do that. Labor costs. So this is current year, which is year 0. So year 1 for the next 2 years forecast. And year 2, let's say this is year 3 and year 4. So labor cost here now is 9 million. For the next 2 years, it's going to rise by 10%. So this is going to be 9 times 1.1. This raised to power 1, of course. We know this is year 0. We want to do what we did yesterday. This is going to be 9 times 1.1 raised to power 2. So here will still give me 9. 9 1.9. Let's check the other one. 1.1 raised to power 2 is 121. You multiply it by 9, that gives you 10.89. So that is 10.89. That is what this is saying, 10.89. Then we are told that, and then in line with the general rate of cost inflation, and then in line with the general rate of cost inflation, meaning that here this will be 9.9 times 1.1 raised to power 2, which is this, multiplied by the inflationary rate is what? The inflationary rate is 2%. So this will rise by 2%. 1.02 is raised to power 1. Then here will be raised to power 2. So it means that for year 3, everything here is the same thing as this, which is this 10.89. So you just say 10.89 times 1.02. So this will be that for year 3, 11.178. And for year 4, you are having multiplied by 1.02. So you're having 11.33. So you're having 11.33. That's your labor. So this is your labor cost for the next 4 years. Then you're looking at the general, okay, the general has been given to you. Then we now said other costs will rise by 2% alone. So what it means here is other costs, first one here is 27M. So here will be 27 times 1.02. Here will be 27 times 1.02 raised to power 2. So let's just do this 2 years. So this is 27. Here will be 27 times 1.02. That will give you 27.54. 27.54. If you times it again by 1.02, you will get 27.54. If you multiply by 1.02, you have 28.09. 28.09. That's what this is saying. Now it means that your total cost for the first year is 36. Other cost here is 37.4. For year 2 is 39.0. So you have done that. Then depreciation charges for each year. What do we have about depreciation? They said the company currently has 100 billion of freehold, 50% of it is land, 50% is building, and 40 million at cost of other non-current assets. We are told that buildings are depreciated by 2% per year. Land does not depreciate. Other non-current assets are depreciated over 8 years by straight line method. So let's see. So what it means here is land. So this is your land. Current year is 50 million. Building is 50 million. Then you have other non-current assets. Yeah, 40 million. And we say that buildings are depreciated 2% per year. 2% per year. What does that mean? For the next year, this one will remain 50, this will remain 50, this will remain 50 times 2% out of 100. That will be 98. 0.98 raised to power 1. That will be 50. 0.98 raised to power 2. So let's see what this will be. So this is going to be 50 multiplied by 0.98. So the depreciation is just 1. So 1 is going off here. So this is going to be 49. Okay. So if you come again and multiply this by 0.98, that will give me 48.02. So here will give me 48.02. So that's what your building is going to be. Other non-current assets, they are depreciated over 8 years in straight line method. So what it means here is depreciation will be 40 minus 0, which is the residual value, divided by the number of useful life. Number of useful life is 8. So 40 minus 0 is 40. 40 divided by 8 is 5. 5 times 8 is 40. So by 5. So this will be less by 5. Here will become 35. This will be less by 5. So that's here. Okay. It's 5. Okay. See it here. It's not being shown here in the workings. Okay. It's not being shown here in the workings. That's fine. So now what are we going to do now? We are told investment in working capital is currently 120 million. Okay, so this is what is now saying here. Depreciation, okay, we've done that, 50 million. If sales increase by 6%, it is assumed that working capital will grow at the rate of 6%. So we said before that our sales was 6%. Where did we do that? 5 point this. So we assume that your working capital will grow at 5.737. We decide to use that. And we can say now working capital is 120 M. Assume to grow with the same rate as sales, 5.737%. So what it means here is this is going to be here 0, 1, 2. This is 120. We will now add 5.7. Okay, now we'll now multiply. All we'll be doing will be multiplying by 1 point. Okay, let me write this thing well. All you'll be doing now is to multiply by, now this is 1 point, we convert this to fraction, 0.05737. So this is raised to power 1, give you this, raised to power 2. So this is raised to power 1, this is raised to power 2. So let's try that again. So we have 1.05737 multiplied by 120. That will give me 126.88. What's happening? What just happened? Just a moment. Okay, let me share my screen again. All right. All right, so we'll do our calculation again. This 126 8, so I'll write it 126.88 multiplied by 737. That gives me 134.164 or 134.16. 134.16. Okay, so that's what our working capital is going to be. It's going to grow at that. So you can now see. So now when you are now doing your current year revenue is 80. And because your revenue is growing at 6%, because it's growing at 6%, it's growing at 6%. We didn't do that. Your revenue is growing at 6%. Let's do that of revenue so that we'll do it. So this is your sales revenue. So we have year 0, which is 80. So this is year 1. This is year 2. So we are saying it's growing by this amount. So I will just simply say 80 multiplied by 1.05737 is going to be 84.59. 84.59. I'll still multiply by this same amount, 1.05737. This is 89.44. 89.44. That's the sort of thing. That's the sort of thing we have here. Sorry, my network. I don't understand what's happening. So it appears that someone is calling my line, and that's what's happening. So you see, 84.8, we have our 84.5 because they use 6%, we use something lesser. And here they use 6%, they get 89.9, we're having 89.44. So it's still the same thing. Then your cost of sales, we said is 40% because the question is saying here that your cost of sales here, your cost of sales, um, what's the cost of sales? Okay, this is the current sales. Um, we said the gross profit margin is between 57 and 62. And we did an assumption that it means that averagely cost of sales, we didn't do cost of sales here, but we'll explain it in the other time. Cost of sales, let's do cost of sales. Cost of sales. So we said it increased between 57 to 62. That is what we were told. 57 and 62. All we need to do here is get the average. These are 2. So when we add them together and divide by 2, then an average of about, let's do them together. 57 plus 62 divided by 2, we're having 59.5. So we can use 59.5 to 1 2. So if cost of sales is 59.5, then normally here we will now use 59.5 of 80. So we'll now look at it now. Let's divide it by 100. Now let's multiply by 80. We're having 47.6. No, 47, yeah, 47.6. 47.6. In this example here, they use 48 because they use assume it to be, sorry, they use 32. They assume it to be 40%. What did I do? 40, they use 40%. How? Sorry, gross profit. What I was doing is gross profit. Gross profit. So this is, sorry, I've made a mistake. This is gross profit. So this is gross profit. Gross profit is going to be 57.6, right? Okay. So it's going to be 57.6. So let's just put it here. We still need it. 47.6. So it means that our cost of sales is 100 minus 59.5, which is 40.5. So this is like 40.5%. So if you look 40 times 5% of 80, 40.5, let's divide it by 100, then multiply by 80, it gives us this 32.4. So this is 32.4. So if we do the same thing here, 0.04, okay, 0.405 multiplied by 84.59, that will give me 34.26. 34.26. And here we have 0.405 multiplied by 89.44. That will give me 36.22. So that's 36.22. So that's what is here. So when you less them, you have your gross profit. Other costs. Look at the other costs we calculated before when we did our labor and the other costs. And we have these. We bring them down here. Okay, you less them and you have all of this. Then we have your depreciation. Of course, we're not doing the current year. Everything we're doing is for year 1 and 2. Depreciation in buildings. We had 1% and 1 each when we did that. Where is that depreciation? In building, we had 1. I think it's still the same 1. So that's what is put down here. Then other non-current assets. Other non-current assets. We got how many? 5, which is the 5 that is put here. So we are adding this back to all this. Increase your working capital. So they say your working capital is increasing by how many? We said our working capital increased by, where is the working capital again? Increased by the same way that sales increase. Although we use this, they use 6%. So it means that they use 6%. So what they mean here is if we have 120 multiplied by 1.06, what's happening? Sorry for the network. Sorry for the network. So it means that if we have 120, and it is growing at 6%, it means the next one will be times 1.06. That will give you 127. That's why you see 7 here. Times again times 1.06. So 27 to 34. So 27, 28, 29, 30, 31, 32, 33, 34. Okay, say 35. That's 8. So the difference between 127 and 135 is 8. That's what we have here as our recording. All right. So we've talked about how these ones were increased from 120 to 127. We have 7 here. From 127 to 135. That's why we have 8. So when we adjust it, this is the EBITDA changes for working capital. Right. So we're going to skip certain things here, go straight to what we call the Baumol model. Let's go straight to the Baumol model. Now, what is the Baumol model and the Miller-Orr model, which is the main thing here? The purpose of cash models. Cash models might be used when an entity has periods of cash surplus and periods of cash deficit. Now, this model can be used to decide how much to hold and how much to invest into short-term assets to earn interest. And when this cash are needed, how many investments should we sell in order to obtain cash? And so we have two models to use. The Baumol model. The Baumol model is similar to the EOQ. You know the EOQ? We need to adjust the EOQ for the Baumol model. So it means here that if this is your EOQ, so this is your EOQ, which is um, square root of 2 DCOO all over CC. Okay, so this is your EOQ model. So we are going to adjust it for Baumol model. The purpose of the Baumol model is to calculate the optimal amount of cash that should be obtained each time short-term investment are sold. Company uses cash at a constant rate throughout the year. That is one assumption. It means they use the same amount of cash every day as an average, the company can replenish its cash immediately as soon as cash runs out. It means that whenever they call for cash, it gets sorted almost immediately. Cash is replenished by selling short-term investments, and these investments are earning interest and they can be sold quickly. Then the holding of cash has a cost. The cost is the opportunity cost of not investing that money to earn interest. So that is called CH, or the carrying cost. I can call it CC. I can call it CC or CH. Sometimes it's called CH. So I can change this now from CC, which is carrying cost, to holding cost. I call this CH plus holding cost, carrying cost. Wow, what just happened? Right? Now, the selling of securities or investments to obtain cash has a transaction cost similar to other costs, which is called your CO, other cost. But in this case, it is called transaction costs. The maximum amount of cash is therefore the average cash holding is X over 2 times holding cost. So this is the formula. This is the formula like I get 2DCO or COD divided by CH. Remembering that your transaction cost is like your other cost, while your the opportunity cost of holding cash is always expressed as a percentage. The investment and an interest, which is the annual cost of holding cash. So if you look at an example here, Omegbegbe Nigeria makes payments to its creditors of 3 million a year. So this is the annual demand. This is your annual demand of creditors. So this is like your D at an equal rate each day. Each time it converts investment into cash, it pays a transaction charge, which is the carrying cost. Transaction charge is the carrying cost, which is the ordering cost, sorry, ordering cost. So this is your CO. This is your CO. Then the opportunity cost of holding cash is CH. Using the Baumol model, what is the quantity of investment that must be sold to raise cash? So we say our formula is 2 COD all over CH. We put a square root, then this 2 is constant. CO, we said the CO is 150, then your D is the annual demand, then your okay, need to fear of network is the beginning of wisdom. Okay, so now we need to convert our 6% into fraction. That's why it is 0.06. So when you do that, let's do it together. 2 multiplied by 150 multiplied by 3 million divided by 0.06, that gives you a high figure of 450 million. How do you find the square root? You just click on the square root. It gives you 122,474. That's what we have here. So this is the amount you must investment. What this amount that you must sell in order to meet your cash demand. So you can round it up to 122,500. So it means that if you round it to 122,500, how many transfers do we need to do during the year? So it means that anytime you want to raise cash, if you want to raise cash, you raise 122,500. If you want to raise 122,500 each time you make a transfer or you make to sell an investment, how many times will you sell your investment? It means you have 3 million for the year divided by 122,500 each time you want to raise cash. You have 24.48. So you are going to sell between 24 times to 25 times. Minimum of 24, maximum of 25 times during the year. Now that's BOMO model. We're not going to talk much about it. Now in the Miller-Orr model, the, the model recognizes uncertainty in cash flow. BOMO model assumes that cash payments are evenly spread. But in reality, this is not likely to happen. Most times in your exam, you will be asked to use the Miller-Orr model. Now, the Miller-Orr model recognizes cash uncertainty, which are measured statistically, and daily cash flow might be okay. So when a cash is moving up and down here, this is safe limit, nothing is happening, you allow them to play. The moment it touches the lower limit, it has triggered a bell. Don't allow it to go below this lower limit. Do something. You will now sell an investment and bring this cash limit immediately to the return point. Then you keep allowing them to go up and down, go up and down. It goes up, it goes up. The moment it hits the upper limit, another alarm is hit. It is too much. Don't allow it to go higher than that. Invest the remainder. So you take away some cash and bring it to the return point. That's what I call return point. The moment it hits the lower limit, you invest enough to bring it to the return point. The moment it hits the upper limit, you take away or invest in the much that will bring your cash flow to the return point. So that's what it is. Now, the difference between the upper limit and the lower limit is called the spread. And the spread has a formula which will be given to you in the exam. If the cash balance, okay, the distance between the lower limit and the return point is usually 1/3. So if you look at it, the return point is, if you divide this into 3, this return point is closer to the lower limit, so it is like 1/3. Then upper layer, the return point is like 2/3. So what it means is that the upper limit, the distance between the lower limit and the return point is usually 1/3 of the spread. So you'll be given the spread formula for you to look for the upper and lower limit. So look at the spread formula. You may not need to cram it because it will be given to you in the exam. So this is the spread. All you need to know is to Okay, so this is the formula. Now you will need to learn how to use the formula. So what I will tell you to do is to do the bracket first. And after everything, you now multiply by this 3. So your 3 over 4 is just there. Keep it. Transaction cost, which is the cost of the sale and purchase of security. The transaction cost is that cost, what it costs you to make the sale and securities, not the actual purchase, what it costs you to make them. Then variance of cash flow. You might be given standard deviation of it. You need to multiply, you need to square it to get your variance. If you are given variance, just use the variance. If you're given standard deviation, you need to square it to get your variance. Once you get the variance, you multiply it by the transaction cost. You also multiply by 3 over 4. You have your numerator up there. Then your interest rate as a proportion. This your proportion of your interest rate. You need to make it daily interest rate. So you need to, first of all, so you need to, first of all, make it a, a proportion. So let's say you are given 6%. All you need to do is 6% is 6 divided by 100. Then you have gotten the interest rate for the year. You now need to divide it by 365 for you to know what to put there. So this is like 0.040. That's why you see this minus 4. It's like 0.0000164. So that's what you are going to put down here as your proportion. Then when you divide the numerator by the denominator, you have gotten this thing here in the bracket. Then you now need to multiply them by 1 over 3. Raised to power 1 over 3 is just like saying this is the cube root. This is like saying this is the cube root. After getting the cube root, then multiply by 3. I think we may need to take one question on this in our next class. So that means we'll take one of these questions in our next class before we move to the next topic. So we have come to the end of our class for today, which is the cash budget or the cash management. We've seen the reasons for holding cash. We have seen the Miller or model, which we're going to do one question on. Then we've seen the Bowman model. We're going to take a question each of this model before we move to the next item on our list. So thank you so much for coming to class, and it has been a nice time here with us. And we are going to have our next class very soon. So thank you once again.